So good morning. This is the beginning. It's July 15th. This week in the Global Forecasting School, we're going to be focusing on two new topics this week: endogenous money creation. And so I'm very happy to have Shelva here from the National Bank of Georgia, who is going to be helping me with the lecture on this topic and everything that you need to know to be a central bank economist, supporting either monetary policy or macroprudential policy analysis and so on. So the way that we're organized in the Global Forecasting School is to have as little lectures as possible. So we take every hour and break it into 45 minutes. And so I'm going to take you through the very first part of a discussion about endogenous money creation and its implications and so on. And we're going to do that in three 45-minute sessions. Immediately after each 45-minute session, the students are going to take their iPhones and they're going to make an audio that basically in 7 minutes maximum, so it can't be any longer than 7 minutes, they're going to upload to our WhatsApp channel an audio indicating what it is they've learned over the last 45 minutes and what have they internalized to explain the story about in their own words and so on. So we're not looking for any fluff in these audio files. The first 2 minutes of the audio files has to be very succinct, as if you've just run into the governor and he's found out what it is you're working on, and he wants to have a 2-minute little summary of it because he's got an important meeting in the afternoon with the IMF, and he believes that what you're learning has some incredible insights that he might want to use in that meeting. Second, the next, again, maximum of 5 minutes, you run into the head of the Monetary Policy Department. He has just received a call from the governor, and the governor has said that he's found out that one of your staff members is working on a really interesting question. The head of the Monetary Policy Department is running to the governor to give him a briefing, and so we asked you to give him a 5-minute summary of what you think the key insights are about the subject matter. So you have to cut a 7-minute audio file. You submit that audio file through WhatsApp to everybody in the Global Forecasting School, and everybody's participating in the summer school and so on. And then those audio files then are evaluated, and we provide feedback the next day and so on, as well as indicate if there are anybody that have passed the test. So let's get into endogenous money creation. Before we do that, we want to say that at the same time in the school, we are getting all of the students to prepare case A and case B scenarios. So case A scenarios are these scenarios where interest rates need to be higher than what's priced in financial markets. And what I mean by that is not the policy rate today, not just that, but the expected path of the policy rate, because that is what monetary policy is all about. Not just setting this policy rate that's irrelevant to most people in the economy, but the expected path that influences longer term interest rates and, of course, the exchange rate and so on. So part of everything we do in terms of developing frameworks to support either monetary policy or macroprudential or even fiscal policy, is to organize our analytical framework around three essential ingredients. Where's the economy today? What are the underlying forces? And of course, the one that separates the central banks that have developed forecasting and policy analysis systems, and this can be either FPAS Mark 1 or more recently FPAS Mark 2 at the Central Bank of Armenia, where we've implemented the prudent risk management approach to monetary policy. So what separates those central banks is that third question. And so non-FPAS central banks like the United Kingdom or the Bank of England or the ECB or the Bank of Japan or Brazil don't try to ask or develop analytical frameworks that are sophisticated enough to be able to ask that last question: what do I need to do with my instruments to achieve my objectives, and so on. So this obviously is applicable to any economic policy, so that's just a summary of where we are in terms of developing state-of-the-art monetary policy and frameworks to deal with monetary policy. Now, I'm going to talk a little bit more generally about why we need similar frameworks to do macroprudential policies to avoid financial instability and so on, and potentially frameworks to study fiscal issues. Because if we were to run into a fiscal crisis, in other words, a situation where there was a perception that the government could not get its act together and generate primary surplus that was sufficient to deal with the interest obligations on the debt and to finance expenditures and taxes. If there was a perception that the debt dynamics were explosive because they couldn't get their act together, that could result in a fiscal crisis. And if it were to result in a fiscal crisis, it would almost certainly result in a financial crisis, because financial institutions are holding all of these government bonds on the asset side of their balance sheet. And in an environment where interest rates were to rise because of the fear of a fiscal crisis, they would suffer humongous capital losses on those bond portfolios and other portfolios like their loan portfolio and so on. So we have in the global forecasting school identified this problem that we think is very real in the economy right now, and it's called the narrowing corridor theory of financial instability. And so, in a nutshell, what the narrowing corridor theory of financial instability is the following. When we get hit by the effective lower bound, you can see this in the chart. So when the interest rate gets close to the effective lower bound, then obviously central banks have to find some other policy instrument to replace the space that they've lost by being at or expected to continue to be at the effective lower bound. And so what have advanced economies used? Well, unconventional monetary policies, the combination of QE, in other words, large-scale asset purchases of other government securities or things like mortgage-backed securities and so on, as well as unconventional forward guidance. And so the term, unfortunately, forward guidance, the way people think about that term, forward guidance, because of the focus on advanced economies, is really unconventional forward guidance, which is telling financial markets that you plan to keep the interest rate low for a very long time. Okay, so the combination of large-scale asset purchases and telling financial markets that you're going to keep the interest rate low for a very long time, reduces long-term interest rates. And this is what the problem is. One, it results in a big increase in the balance sheet of the central bank. Two, it also tends to be supported by expansionary fiscal policy, so it results in a large increase in government debt. And three, which is an unintended consequence of those policies, it drives asset prices in some cases to Mars. Okay. So this is looking at the US experience. So what happened during COVID? Well, between sort of late February, last week of February of 2020 and the end of March of 2020, we had a period of extreme uncertainty. We had COVID and we had no vaccine in sight. And so as a result of that, there was humongous uncertainty about how infectious this disease might become, as new variants became more successful at spreading, but more importantly, how virulent or how deadly the disease was and what implications it had for shutting the economy down. But just think about that. That shock by itself should have reduced asset prices, equity prices, which of course are the future discounted value of dividends of firms. And so obviously, if the firms are producing less output, equity prices should fall, which they did. They fell about 35% in February and through March of 2020. But then with these extremely expansionary monetary and fiscal policies, so the fiscal policy was, giving big transfers and so on to the households and so on. The expansionary monetary policy, as I said, was more unconventional monetary, which was, more asset purchases by the central bank, as well as this unconventional forward guidance that gave people the impression that they were going to keep interest rates low for a long time. The problem with those policies of unconventional forward guidance and so on is that if they're successful, there's going to come a day when the economy escapes the low inflation trap and the low interest rate trap. And when that day happens, there's going to be a very disruptive adjustment in financial markets, much like there was during the Bernanke taper tantrum and so on. And as a result of that, financial markets are going to be without a framework for thinking about what monetary policy is going to be governed by in that world and so on. But just to give you an idea of how big these potential asset bubbles could be, we're going to look at the U.S. household balance sheet. Okay, and if there's a problem with the U.S. household, chances are there's a problem with many other balance sheets in the world. These are, commercial bank balance sheets. These are balance sheets of other countries that are much more vulnerable than the United States and so on. So if there's a problem in the US, then there's a problem in many markets in the world. So let's look at what happened. Well, as I said, global equity markets fell by about 35% through starting in about the third week of February through the end of March and so on. And then again, with these expansionary monetary policies over the last 4 or 5 years, equity prices have gone truly to Mars. The S&P has doubled. It was 5,000 at the end of the first quarter of 2020. It's gone through 10,000 and is currently around 10,600. So there's been a doubling in equity prices in a world where you might argue uh, uh, equity prices should be lower because output is higher, because output is lower, and so on, cumulatively and stuff uh, since say before COVID started. So what effect have these equity prices plus about a 50% increase in property prices? So we've had um, equity prices go to Mars. Property prices, luckily, haven't gone up as much because, as we will see when we get into the second part of the lecture, when we talk about endogenous money creation, property prices are the combined with an excessive credit expansion are the best leading indicator of all past banking crises and financial crises and so on. So we're looking at the implications on the household balance sheet, the U.S. household balance sheet, which as you can see, also includes nonprofit organizations. That's if you threw out nonprofits, nothing really would change here. So, how much did U.S. Household assets increase? The answer is $53 trillion. I want you to understand the significance of that number. $53 trillion increase in the US household assets from the end of the first quarter of 2020 to the end of the first quarter of this year. In 2019, the entire the entire value of goods and services produced by the US economy in 2019 was $21 trillion. So this 53 trillion increase in US household assets was over twice as much of US GDP. Just to put this in perspective, government debt in the US is about 100% of GDP. So the increase in household assets has been more than double the level of GDP, as well as the entire cumulative sum of government debt in the U.S. economy that has been accumulated over the last, I don't know, 100 years or so on, effectively since the early 1950s and so on. So, um, so when you look at that $53 trillion increase in household assets, there were three things that caused that. One, the doubling in equity prices. Two, the increase in property prices. And three, some good old fashioned financial saving during COVID, which was effectively a result of precautionary saving because the world was very uncertain. And so obviously people wanted to save and accumulate assets to deal with uncertainty in the future, as well as the fact that people couldn't consume their desired consumption bundle in the early stages of COVID. And so that's based on the idea that if you can't consume that international vacation and so on, that you're not going to substitute towards other things and so on. You're going to save the money until you can do it. Now, so why have these assets increased so much? Combination of an asset price bubble, both in the property market, which has increased by about 50%, and a humongous increase in equity prices, plus some saving that was done during COVID. We have Miriam with us. Maybe she can light up by unmuting for a second. But she has recently put out a working paper at the National Bank of Georgia that shows that these measures of financial assets, once we subtract off liabilities, that this measure of net wealth plus disposable income, when those two variables are used to model U.S. consumption, they explain most of the variation in quarterly consumption. It is the best fitting macroeconomic relationship of any macroeconomic relationship in the US, aside perhaps maybe Okun's law, okay, the relationship between output today and where unemployment goes in the future. There might be a little bit of a competition there between the consumption function and so on. So before COVID, from about the early 2000s up until the end of 2019, are standard consumption functions that feature this measure of US household wealth plus disposable income plus a measure of real interest rates, has a standard error of 0.3 percentage points. So in other words, the conditional prediction of consumption, if you know last period's measure of wealth and this quarter's measure of permanent disposable income, which actually is pretty easy to construct and to use in real time, those variables explain consumption almost perfectly. So what happened during COVID? Obviously, the consumption function shifted when households were getting these massive transfers. Disposable income went way up at the same time when there was lockdowns. People couldn't consume what they wanted to consume. So the consumption function was completely broken. And so in this empirical work that Miriam did with a few others that features disposable income and a measure of permanent disposable income plus this measure of wealth, it can explain consumption perfectly again after we allow for shifts in the consumption function from 2020, 2021, and 2022. Okay. And so the idea is that the consumption function was shifting because of increases in precautionary motives or because people couldn't consume what they wanted to consume. So we have control variables that try to pick that up. But then we have other control variables that allow for things like revenge spending when the economy is opened up and so on. And so if you use those control variables effectively to look at those 12 quarters in 2020, in other words, Q1, Q2, Q3, Q4, 2021, and 2022, and then you formulate a hypothesis. What if those effects are effectively all over by 2023? That hypothesis is not rejected by the data in the sense that the same parameters that predicted consumption almost perfectly before COVID, okay, are also predicting consumption perfectly in 2023 and the first quarter of 2024. What that means is that there's not a puzzle. For many people, there's a puzzle because they first predicted that we'd have a recession when the US raised the Fed funds rate by 500 basis points. And then, of course, the guys that believed in macro financial linkages, people like me, that looked at things like bank lending tightening from measures like the Senior Loan Officer Survey. It is tightened enough that on the basis of that one indicator, you would probably predict a recession. But there has not been a recession. And so the puzzle goes away entirely once you realize that if the US consumer is going to continue to be strong and resilient because of high wealth, because they can support these high levels of consumption. So that explains why we have in a recession up to this point. Now, the fact when we're dealing with the effect lower bound, that it has such enormous effects, unintended consequences on asset prices, that becomes very problematic because if you escape from a low inflation trap, straight trap, as we have, you might be in a situation where you face stagflationary shocks. And when you face these stagflationary shocks, there would be concerns that there's going to be this critical threshold at which you can't raise interest rates above it. In fact, you might even not be able to get close to it because concerns of unstable debt dynamics and so on. And so um, the chart that we are looking at right now is the 10-year bond rate for Italy. The reason we chose Italy, because obviously the European debt crisis in 2011, so this was the period after the global financial crisis. And as you can see in the chart, the 10-year bond rate on Italian bonds was 7%. So 7% is probably a good estimate of what the critical threshold might be. Now, we want you to understand how to think about that. Okay, so when the interest rate on 10-year bonds gets up to this really high number, and when financial market participants go through the thought experiment, what do I need to do to the primary balance to make the debt dynamics sustainable? So now I'll just talk about the US, who has a debt to GDP ratio of 100%. And so if the 10-year bond rate, which is approximately the average maturity structure of US debt, it's a little bit lower. It's more like around 8 years. And obviously, it would take time for the debt to roll over. But once financial market participants go through the logic that if the 10-year bond rate or the 8-year bond rate was 7%, with the debt to GDP ratio of 100%, that means that interest payments would have to be 7% of GDP, which means that we'd have to generate a primary surplus. In other words, we'd have to have government expenditures less than taxes. So we'd have to cut government expenditures a lot, and we'd have to raise taxes a lot to convince these financial market participants that we are serious at controlling the debt dynamics. And here comes the second issue. If we're in a situation where there's conflict in the political system, where we think that it will be virtually impossible for the government to come up with that primary surplus, then the perception of a fiscal crisis is justified and interest rates rise even further because bond market participants are not going to want to hold these bonds if they think there's a good chance that interest rates could rise in the future. So this is motivation for why we need much, much better models than these infinite horizon models that people play with in academia. We need to have models that have overlapping generation structure with endogenous money creation so that we can study both fiscal policy and macroprudential policies at the same time. So this is where we're going to go today. In the first part, we're going to provide just a little bit of motivation for an intuition for what endogenous money creation is. In the second lecture that will start at 11 a.m., we will get into a very specific model that we developed when I was at the IMF, but based on infinite horizon assumptions. And we'll show you how far we can push those models and why they have extreme limitations, why we need to be extending them to have more heterogeneity and an overlapping generations structure to start building serious models with endogenous money creation. This is just a slide that shows that luckily we got some inflation in response to COVID, so that this $53 trillion in the U.S. Household balance sheet did not rise as a share of disposable income by quite so much. But you can see that it resulted in a 100 percentage point increase in the asset to disposable income ratio. So we didn't have enough inflation to inflate away all of this. So that's the real part of it. Now, what is endogenous money creation? I've got 10 minutes to explain that. Well, what we need to do is to compare it with what we might find in your common textbook, which is what we refer to as a loanable funds model of banks, which is this idea that banks collect deposits from people and then take those deposits and lend them out to finance investment projects. So the role of banks in this loanable funds world is simply to act as an intermediary between the people that want to save in the form of deposits and the people that want to borrow to build investment projects or to finance some other type of activity. Now, let me just say that that this view of banks is totally wrong, but it's not just totally wrong, it's dangerous. Because when you understand how banks work in the real world, one has to realize the enormous vulnerabilities associated with modern financial systems. So, how do banks work in the real world? People go into banks to take out loans, and the minute that loan is granted, there is a matching bookkeeping entry on that bank's balance sheet. In fact, the entire balance sheet of the commercial banking system. So a deposit is created at the same time that the loan is created. That deposit is used to purchase, let's suppose that it's a house. So somebody's going in and getting a mortgage for $1 million. The minute that that person gets the mortgage for $1 million, he gets the $1 million in a deposit so that he can then pay for the house. So we know at that point that money or purchasing power has been created in the economy. We know that most of the money that is created and used in the economy is this kind of money. It is not cash. It's not printing cash or anything like that. It's through the process of making loans. Why does that make the economy potentially vulnerable? Well, we have to ask, what is money used for? Money is used for three things. One, to finance consumption purchases. So we need money to buy our consumption goods and so on. Money is also used to purchase investment goods. And lastly, it is used to purchase existing assets that could be at really high prices, like I've shown you, we're observing today. So we know that there's been enough money that's been created by the financial system to generate this humongous increase in asset prices. And that's very, very risky because if the financial institutions, the commercial banks that are creating this money are not aware of the risks that it's imposing on the global financial system, if they can't see that, if they underprice that risk, perhaps because policies are not speaking about the potential risk. If you look at the financial stability report of the United States, it doesn't indicate that something really bad might happen over the next several years. In fact, the financial stability report didn't even consider higher interest rates and so on. So there's institutions in the world, such as central banks, that don't seem to be very concerned about this. The BIS doesn't seem to be very concerned about this, even though it's their job to worry about this sort of stuff. And I think that's partly simply because they don't have an analytical framework to figure out what the right way of regulating the economy is in this world. So in this world, what determines the decision for these commercial banks to make that loan or not And the answer is this: is it profitable? And do they think people will pay it back? So perceptions in the banking sector, as well as the overall economy, are critical about whether or not people have confidence in the financial system. If they have confidence, then everything works out okay. But if they were to come to realize that these problems are much bigger than what they thought before, then one could have effectively a credit crunch or a destruction in money as banks stop making loans to people, or people stop asking for loans because they're concerned about the future. So I'm going to end it just a little bit earlier. My drop dead deadline is in 4 minutes, but I will ask maybe Shelva if he has any feedback to what I've said, recognizing that we have to end at 10:45.
Yeah, I think you've discussed this very nicely. The only thing I would add is when we think about banks being intermediaries, we say that they are not intermediaries in a physical or literal sense. They don't, in a sense that they don't wait for some additional depositor to come before they make loans. But of course, if we generalize the word intermediary in a sense of creating these bookkeeping entries and then finding people who want to hold their newly created deposit and finding people who want to borrow. If we think intermediation is finding those two kinds of people, then we could say that banks are intermediary, but not in a literal sense, but in a this kind of a demand sense. So that's my only comment.
Okay, very good. Okay, so now we will have a break for 15 minutes. And of course, the very first thing that we want the students to do is to go somewhere and to cut an audio file that is no more than 7 minutes, maximum 7 minutes, that has two parts to it. 2 minutes formulating, something about what you learned and what you think the governor needs to know. Okay, 2 minutes, no fluff, please. And then 5 minutes to a very busy head of a monetary policy department that is rushing upstairs to inform the governor about the subject matter and so on. So everybody cuts that audio, sends it to our WhatsApp channel. We'll be doing that now. We'll be doing it at the end of the second session. We'll also be doing it at the end of the third session. Okay, so see you back at 11 o'clock, and thanks.